You see it everywhere. Your cousin just made 15 grand on some crypto coin you've never heard of. Your coworker won't shut up about their stock portfolio going up 30% in a month. Even your Uber driver is giving you investment tips. And you? You're sitting there watching everyone else get rich while you do nothing. So you finally cave. You open that trading app, throw $1,000 at whatever's trending, and then it crashes. Suddenly you're down 40%, and everyone who was bragging last week has gone silent. Sound familiar? That's FOMO investing. Fear of missing out. And it's not just draining your bank account. It's hijacking your brain's decision-making process in ways you probably don't even realize. In today's video, we're breaking down the psychology behind why smart people make terrible investment decisions. We'll explore what's actually happening in your brain when you panic buy stocks, why social media is designed to trigger your FOMO, and most importantly, how to make financial decisions that don't leave you broke and stressed. This is your reality check. Let's get into it. First, let's be clear about something. This isn't about you being dumb or impulsive. You're up against a perfect storm of evolutionary psychology and modern technology that's literally designed to make you act against your own best interests. Here's what's really going on. Your brain evolved over millions of years to keep you alive in a world of predators and scarce resources. Back then, if everyone in your tribe was running toward food, you had to run too, or you'd starve. That instinct, that fear of being left behind, it kept your ancestors alive. Today, it just makes you buy Dogecoin at its peak. This is called herd behavior, and it's hardwired into your neural circuitry. When you see other people profiting from something, your amygdala, the fear center of your brain, lights up. It interprets missing out on potential gains the same way it would interpret missing out on food, as a survival threat. But here's where it gets worse. Social media platforms have figured out exactly how to weaponize this instinct. Every screenshot of gains, every success story, every "I told you so" post is algorithmically designed to trigger that fear response. The platforms know that FOMO drives engagement, and engagement drives ad revenue. And the investment apps? They're in on it too. Push notifications about hot stocks, red and green colors that trigger emotional responses, gamification features that make investing feel like a slot machine, even the confetti that falls when you make a trade. It's all designed to bypass your rational decision-making and hit that dopamine button directly. You're not fighting your own weakness. You're fighting a multi-billion-dollar industry that profits when you make emotional decisions. Here are the telltale signs that your investment decisions are being driven by fear instead of strategy. 1. You invest based on what's trending. If your research process is scrolling through Wall Street bets and buying whatever has the most rocket emojis, that's FOMO investing. You're letting strangers on the internet make your financial decisions. 2. You can't explain your investment thesis. Someone asks why you bought a stock, and your answer is, "Everyone's talking about it," or "It's going to the moon." If you can't articulate why something is a good investment beyond social proof, you don't have a strategy. 3. You check your portfolio obsessively. Opening your investment app 50 times a day isn't due diligence. It's anxiety. When you're constantly monitoring price movements, you're not investing. You're gambling, and the stress is telling you something. 4. You invest money you can't afford to lose. Using your emergency fund, your rent money, or worse, going into debt to invest because you're afraid of missing the next big thing? That's desperation, not investment strategy. And it's a direct result of FOMO overriding your rational brain. 5. You feel intense emotions about price movements. If a 10% drop makes you panic sell, and a 10% gain makes you feel euphoric, your emotional investment is too high. Professional investors feel neither joy nor despair about normal market fluctuations because they have a plan that accounts for volatility. 6. You buy high and sell low. This is the classic FOMO pattern. You wait until something has already skyrocketed, then buy in at the peak because you can't stand watching it go up anymore. Then, when it inevitably corrects, You panic sell at a loss. Rinse and repeat. 7. You ignore your own research. You spend hours reading about a solid long-term investment, but then you ignore it to chase whatever went up 20% yesterday. That's your FOMO brain overruling your rational brain, and it's costing you money. If you're nodding along to more than a couple of these, don't worry. Recognition is the first step to change. Let's talk about what's actually happening in your brain when FOMO takes over your investment decisions. When you see others profiting from an investment, your brain releases dopamine in anticipation of a similar reward. This is the same neurotransmitter involved in addiction. Literally. Your brain is getting a hit from imagining future gains, and it wants more. At the same time, your prefrontal cortex, the part of your brain responsible for rational decision-making and long-term planning, gets suppressed. This is why you can know intellectually that buying high is a bad idea, but still do it anyway. Your emotional brain is drowning out your logical brain. There's also a phenomenon called loss aversion, discovered by psychologists Daniel Kahneman and Amos Tversky. Their research showed that people feel the pain of losing money about twice as intensely as they feel the pleasure of gaining the same amount. This means the fear of missing out on potential gains actually hurts more than losing money you already have. And here's the really sneaky part. Something called recency bias makes your brain overweight recent events when making decisions. If you've been seeing people profit from meme stocks for the past month, your brain assumes that trend will continue indefinitely, even though history shows us that it won't. Social proof compounds all of this. Humans are social creatures. When we see large groups of people doing something, our brains interpret that as evidence that it's the right thing to do. In survival situations, this worked great. In financial markets, it creates bubbles. The combination of all these cognitive biases, plus the dopamine hit from potential gains, creates a perfect storm that turns reasonable people into impulsive investors. Your brain is quite literally working against you. All right, enough doom and gloom. Let's talk about how to actually break the FOMO cycle and make investment decisions you won't regret. These aren't just feel-good tips. They're practical strategies backed by behavioral psychology. 1. Create a written investment plan before you invest anything. Write down your goals, your risk tolerance, your time horizon, and your strategy. When FOMO hits, and you want to chase the next hot stock, you have to justify it against your written plan. This activates your prefrontal cortex and forces rational thinking. No plan? No investing. It's that simple. 2. Implement a mandatory waiting period. See an investment opportunity that excites you? Great. Write it down and wait 72 hours before putting any money in. If it's still a good opportunity in 3 days, it'll still be there. This simple delay disrupts the emotional urgency that drives FOMO decisions. Most of the time, the compulsion passes and you realize it wasn't that great anyway. 3. Unfollow the noise. Mute the crypto influencers. Unfollow the day trading gurus. Stop reading Wall Street bets for investment ideas. These sources are designed to trigger FOMO. They make money from your engagement, not from your financial success. Curate your information diet to include actual financial education, not hype. 4. Automate your investments. Set up automatic transfers to index funds or ETFs on a regular schedule. Dollar cost averaging removes emotion from the equation entirely. You're investing consistently regardless of whether the market is up, down, or sideways. No decisions to make means no FOMO. 5. Track your FOMO moments without judgment. Keep a journal of times when you feel FOMO about an investment. Write down what triggered it, how you felt, and what you did. This creates self-awareness and helps you recognize patterns. You'll notice your triggers and can develop strategies to handle them. 6. Use the front page test. Before making any investment, ask yourself, if this ended up on the front page of the news with my name attached, would I be embarrassed? If the answer is yes, don't do it. This mental exercise helps you evaluate whether you're making a rational decision or just chasing hype. 7. Set strict loss limits and stick to them. Before you make any investment, decide exactly how much you're willing to lose and set an automatic sell order at that point. This removes the emotional decision-making from the equation when things go south. You're making a rational choice when your brain is calm, not when it's panicking. 8. Remember that missing out is often the best decision. Seriously, most of the opportunities you're afraid of missing are actually terrible investments disguised as get-rich-quick schemes. The vast majority of FOMO investments lose money. Missing out means you kept your money, and that's a win. Remember at the start when we talked about everyone around you seeming to get rich while you watch from the sidelines? Here's what they're not telling you. For every person who posts their gains, there are 10 who lost money and stayed silent. For every overnight success story, there are hundreds of people who panic sold at a loss. The people bragging about their wins? They're either lucky, lying, or they've put in years of research and discipline that they're not showing you. What you're seeing is survivorship bias. You only hear about the winners because the losers don't post. You're not missing out. You're seeing a carefully curated highlight reel designed to make you feel exactly the way you're feeling. That's the game. And the moment you recognize it, you stop playing. Look, building wealth isn't sexy. It's not exciting screenshots and rocket emojis. It's consistent, boring, disciplined investing over decades. It's saying no to hype and yes to research. It's being okay with missing out on the lottery tickets because you're building something sustainable. Your brain is going to keep trying to trick you. The FOMO will come back. But now you know what it is, why it happens, and how to fight it. You have the tools. So what's one thing you'll do differently with your next investment decision? Drop it in the comments. And hey, if you found this helpful, smash that like button and subscribe for more content on the psychology behind your everyday decisions. Thanks for watching. Now go make some smart, boring, profitable investment decisions. Future you will thank you for it.